are high interest rates bad? The conventional thinking tends to be as interest rates rise, while that can be a good indicator of a healthy economy. If the Fed is comfortable enough to hike interest rates, then that means that they're comfortable enough to contract the economy from a theoretical standpoint. Hiking interest rates is a contractionary action, and cutting interest rates is a growth-oriented action there from the Fed. And so if they are hiking, the theory tends to go, it's because the economy is doing well, and that can be cause for bullishness in the stock market. But it's rarely that clean, as anyone who's ever seen a macroeconomist, a teacher or student who's never interacted with the market before, try to trade for the first time. Those formulas and theories rarely play out so cleanly. So I wanted to look at interest rates rising. Are they a good thing, like you might read in a macroeconomic textbook? Are they a bad thing, like you tend to hear practically from voices on the street? Oh, well, if interest rates are rising, then your Apples and your Amazons and these companies that have been reaping the benefits of near 0% interest rate funding, being able to throw money around at their different projects, shooting off people into space and everything, and funding that for near 0% rates, that's going to be a lot harder, and it's going to hamper that business. So it could be, higher rates could be bad for the stock market. We're going to take a look at all of it here, because your 10-year rate has quadrupled in the last 2 years, and the rise in rates has coincided with inflation and bearish stock action. And this is one of those instances where we're not hiking interest rates. This was kind of the case back in 2015, right, where inflation was actually under the 2% benchmark that the Fed likes to keep inflation around. We were under that 2% threshold there, but the economy was doing so well, printing new highs in the stock market, that the Fed just inched interest rates higher, because we were at 0%, inched them up to, I believe, 1.5% before the pandemic, and then had to cut them. From there, this is a different kind of rate hiking environment, whereby inflation and some uncertainty in how far inflation can get out of hand has forced the Fed to hike interest rates. And this has coincided with some bearishness in the stock market. And I generated this graphic, and I knew that it was going to tell part of the story that I wanted to tell, but I didn't know it was going to tell it this well. You have here in black the 10-year U.S. Treasury rate, so just the benchmark for interest rates here in the U.S. And in red, your NASDAQ. Of course, a lot of people look at the S&P 500, and for the next portion of the segment, where we're looking at the last 50 years in stock returns, we will be looking at the S&P 500, but I wanted to highlight the NASDAQ because tech stocks have been so sensitive to these rate hikes. And this image really played out even better than I thought it would, which is to say, these are almost a mirror image of each other here. You can see in that first portion, 2021, the end of 2021 into the mid part of 2022, both markets kind of sideways, and then rates start to pick up in about March of 2022 there. And that coincides almost perfectly with stocks starting to slide, to the point where in the summer of 2022, if you can focus around the middle of that image there, you see 10 years make new highs above 3%. That peak is lining up perfectly with the low in NASDAQ around, this is the Qs, the ETF, around 280, the same time that 10 years just peaked their head above 3%. And as 10 years come off a little bit from that peak, stocks bounce back, really looking like a mirror image, especially from the mid part of 2022 until recently. You see at the end here, the last, call it 2-3 months in price action, 10 years staying flat around 3.5% to 4%, and actually getting back to 4% in the most recent weeks. and the stock market isn't at its lows. It is lower than it was a week or two ago, but not particularly close to the lows that they were at when 10 years were at these rates a month and then 2 or 3 months ago, causing me to start to think, is this relationship as clean as they portray it on so many financial media sites and television shows, which is rates are up again today and the stock market is tanking. Is that a sustainable long-term trend? Has it been historically? And for me to illuminate this concept and hopefully get us closer to an answer as to whether or not high interest rates are indeed bad for stocks, I put together too much data, and we can hang around on this slide for a little bit and walk you through the last 50 years of stock returns. Is the S&P 500 return year by year. And in green, I've highlighted years that the 10-year rate rose. In the 70s is probably your best case for rates being higher and stocks moving lower. As you can see, in 72 through 75, rates are moving higher for that 4-year stretch, and the stock market sees some significant losses, and especially there in 73 and 74, the stock market essentially gets cut in half in that 2-year stretch. But in 75, it gains back a lot of the ground, and throughout the rest of the 70s, gets back to a generally positive decade there. You get into the 80s, and you see about half of that decade years when interest rates were on the rise. And actually only one of those years did the stock market falter. In the 90s, not so many years of hiking interest rates, but again, of those 3 years, netting out to positive stock market performance in the aughts. Of course, in 2000, around the dot-com boom there, you have interest rates on the rise and stocks falling 2000, 2001, and 02. But in 04, 05, and 06, as rates were rising, stock market had positive returns. All of those years, you get to the 2010s, and again, not so many years of hiking interest rates, but 3 out of the 4 years there, positive returns in the S&P 500, and not just positive, but 30% in 13, 11% in 14, and then 20% in 17. The only negative year, down 6% in 18, as interest rates were on the rise there. That brings us to the current moment here, the last 3 years. Interest rates have been rising, and of course, in 2022 and now extending into the start of this year, we've seen the greatest increase of our young decade in interest rates. And the S&P 500 in the last 2 years is down. It's right now, if you're looking at the NASDAQ, I believe we're down about 15 to 20% from the highs that we put in there. S&P 500 not down as much, but definitely lower in the last year and a quarter of action. But this raises the point of, okay, well, if inflation stays a little bit higher and interest rates stay higher, potentially move higher again this year and next year, does that necessitate negative returns for the stock market? And historically speaking, that has absolutely not been the case. Of course, you can go case by case into the different rate hiking environments here throughout the 70s, 80s, 90s, 2000s, 2010s, and the current decade. But I crunched numbers on the averages here, comparing all years of performance in the S&P 500 to those years when rates did increase. And while stock performance did diminish, it did it very slightly. You can see and actually, as a little bit of context, about 50% of the years going back from 1970 until now, interest rates were higher. So a pretty 50-50 split between rate hiking environments and rate cutting environments, which is what you want to see when you're talking about mostly random, especially mean reverting markets like interest rates or Forex or a lot of commodities. Stocks, as most of you know, not a mean reverting asset class. How do we know that? Well, in the last 50 years, 75% of those years, the stock market has moved higher, and it's had an average return of 8.5%. For a mean reverting market, you would want that years of bullishness versus bearishness to be 50-50, and you'd want that average return to be about 0% there. Stocks tend to drift higher. But even in those years when rates did increase, we only lost 5 percentage points of bullish years there, which is to say still a 70% chance that the stock market was going to close the year higher. And the average return was still 5.5%. So in a lot of these environments where interest rates are on the rise and posing a potential nice return for those willing to lock up their money and get those higher interest rates, stocks still very, very attractive, averaging a 5.5% return. And we saw just in that last data set, plenty of years where interest rates were on the rise, getting up to, 6, 7, 8%. And the stock market was doing 20%, 25% in annual returns. And so creates this environment where, absolutely higher interest rates are not necessitating bearishness in the stock market. They're not just a black and white bad thing for the stock market for a number of different reasons. I mean, we don't get too granular on the show because it's only 30 minutes and we're trying to really encapsulate what's going on in our huge, vast economy. But I mean, take it down to the microscopic level of each individual single stock, each company with its line of products, its management, its workers, its factories, its this, its that. And while higher interest rates are going to affect that company and make it a little bit harder to borrow money and might cause them to have to maybe reduce some of their workforce or adjust projections and everything else, it's not this blanket relationship of higher interest rates means the stock market is going to crash. That being said, we have seen downside. I mean, like I say, this has been a pretty perfect picture of inverse correlation. As interest rates have risen, the stock market has fallen. Where we go from here is going to be really, really interesting to me because there's a couple of different opportunities depending on your opinion out there. Of course, first of all, there's a potential pairs trade to be had for either the contrarian or the trend follower in this new trend that we've seen, whereby stocks have bounced back as interest rates have gotten back to their heights. Is one of these wrong, or is this the new trend? Pairs trading can be an opportunity in the short term. By short term, I mean next couple of days to next couple of weeks, because, you could get either on the short side of both of these markets if you think that one of them is wrong here, which is to say, if rates are going to stay high, then stocks have to fall at some point. Or if stocks are going to continue to bounce back, that's because rates are actually not going to get as high as inflation and these other market projections are getting them to. Or if you think, hey, rates are going to climb and stocks are going to climb, and this is just the start of that new trend, pairs trade in there. And of course, something that I stumbled upon, but is one of the most, tried and true elementary strategies is this an opportunity to both take advantage of high interest rates by buying, U.S. treasuries, buying T-bills or notes or bonds, and buying stocks that is quite literally the basis of some of the first diversified portfolios that were ever created, which are just stock and bond funds. And doing that in this environment, you get, a NASDAQ or an S&P 500 or what have you, that's at a great discount to last year's highs, and an interest rate environment that's, depending on what duration you're looking at, 4 to 5 or even north of 5%. Interesting opportunities here, but of course have no clue what is next for stocks, given the heights that we're seeing in interest rates.